Hey everyone, and welcome to today's Asia-US Market Briefing Explainer. If you're a US financial investor tuning in, you already know that what happens overnight in Seoul often acts as a massive leading indicator for your trading day in New York. Well, today we're tracking a very specific aggressive rotation that just went down, and we're going to decode exactly what it means for your portfolio. So let's jump right into it. On the surface, the KOSPI pulled back exactly 0.53% today. Now, if you're just glancing at that headline index number over your morning coffee, you might think it was just a quiet, slightly negative session. But honestly, you'd be missing the real story. Because beneath that superficial index drop, massive institutional capital aggressively rotated. We didn't just see a random sell-off, we saw a highly calculated repositioning by professional money. When you look at the sector heat map from today's session, the contrast is actually staggering. You've got this sea of red in specific legacy sectors, sharply contrasted with bright green in others. What you're witnessing here is foreign capital swiftly dumping legacy memory chip leaders to completely flood into energy storage systems, or ESS, and silicon capacitors. This isn't just noise, it's professional capital seeking a very specific type of safety. Section 1, the dual macro shock. All right, so what actually caused this sudden capital flight out of the Korean index heavyweights? Basically, two independent shocks hit the market at the exact same time today. First, an IRGC attack in the Middle East spiked WTI crude oil prices by over 3%. That instantly elevated oil supply concerns and compounded imported inflation pressures. Then, second, we had an unexpectedly hawkish Bank of Korea. They held rates at 2.50%, but they actually raised their 2026 CPI forecast to 2.7%, which strongly signals higher inflation for longer. That instantly lifted the Korean 10-year yield by 5.5 basis points. So you're dealing with a geopolitical shock and a domestic cost of capital shock completely overlapping in a single session. Moving on to Section 2, tracking the capital rotation. Faced with those dual macro shocks squeezing the market, professional capital didn't just move to cash. Instead, they immediately sought certainty anchors by piling into structural supply contracts. We tracked a staggering 3.45 trillion Korean won exit from legacy memory, specifically Samsung Electronics and SK Hynix. I mean, just to put that into perspective, that is a massive coordinated sell-off. But all that capital had to go somewhere, right? We saw it perfectly juxtaposed against huge inflows into infrastructure and component names that are boasting newly confirmed cash flows. The smart money specifically pivoted away from high beta memory components and straight into assets with validated, contracted demand. We're talking about LG Energy Solutions securing a $1.6 billion contract with DTE Energy and Samsung Electromechanics locking in a massive 1.55 trillion won silicon capacitor deal. In a risk-off environment driven by macro shocks, guaranteed near-term cash flows become an absolute premium asset. That is your certainty anchor. You might be wondering, who exactly bought what the institutions were dumping? Well, during this massive transition, retail investors stepped up and absorbed roughly 96% of the institutional selling. This is absolutely crucial for you to take away. Those vacated memory and high beta tech positions are now sitting squarely in retail hands, which creates a massive structural overhang in the market moving forward. Institutional money is out, retail is essentially holding the bag on those specific names. This brings us to Section 3, Hidden Signals in Tech. Now, we have to be careful not to paint with too broad a brush here. If we dig a little deeper into the technology sector flows, we spotted a targeted beta reduction repositioning, not just some full panicked market exit. Foreign investors aggressively dumped semiconductor capital equipment like Jusung Engineering. But in the exact same session, they were actively buying up SSD controllers and backend components like Fadu and Lino Industrial. Why? Because Fadu just signed a brand new 46.5 billion won overseas contract. The theme here, again, is confirmed cash flow. They aren't abandoning tech altogether, they're just shifting from cyclical equipment into components with verified contracted demand links to AI and data centers. Okay, Section 4, Execution, US Market Validation. All right, let's translate this Korean contract-based re-rating into your execution playbook for the US trading session. This is where the Asian close literally becomes your US open strategy. I need you to lock in this specific number for me, 29,981. This is the NASDAQ futures level at 5 a.m. Eastern Time. This is your absolute validation line for execution today. Here's the logic behind it. If the Nasdaq holds above that 29,981 level, our rotation signal remains totally valid as a catalyst for U.S. utility, ESS, and AI hardware names. It means the structural demand story is actively transmitting across the Pacific. But if it falls below that line, the contract-driven re-rating stays contained to Korea, and you really shouldn't expect that rally to extend into your U.S. tech and infrastructure positions today. Finally, Section 5, Final Macro Override Checklist. But no technical level exists in a vacuum. Before you execute a single trade today, you strictly have to monitor the upcoming U.S. macroeconomic releases, because they hold the power to override this entire setup. Make sure you keep this matrix handy on your desk. If core PCE year-over-year exceeds that 3.3% consensus, or if Q1 GDP beats 2.0%, expect a rate hike premium to expand immediately. If that happens, it's going to instantly compress those battery, ESS, and component multiples we were just talking about, totally overriding any structural contract optimism. The macro weather will simply be way too heavy for the microfundamentals to push through. You really need to be on high alert for a stagflation scenario today. If PCE beats consensus, showing us inflation is running hot, but GDP falls below 1.5%, showing growth is basically stalling out, that is the worst-case scenario. This will trigger broad, aggressive risk-off pressure across the board. In an environment like that, even validated contracts aren't going to protect you from multiple compression. So the ultimate question for your execution today is this. Will these structural supply anchors, those multi-billion-dollar contracts in ESS and silicon capacitors, hold firm against today's barrage of U.S. macroeconomic data? Will the certainty of corporate cash flows actually win out over the uncertainty of Fed policy? Watch that 29,981 validation line closely and keep your eyes glued to the core PCE print. Because at the end of the day, the edge goes to the investor who sees the rotation before the opening bell even rings. If you want to keep receiving these institutional Asian market close signals right before the New York market opens, make sure to subscribe. Have a great trading day, and we'll see you in the next explainer.